All right, let's go. It's episode number 5. A ton to get to as we sit here on Friday afternoon and wrap up the 7th, count it, 7th positive week in the row for markets right across the board. The SPY, the Diamonds, Dow, and the Qs all posting 7 straight weeks of gains. We get the Fed this week coming through, finally acknowledging that they are in desperate need of some cuts coming up in 2024. So much to get to. Neil is in the hot seat this week. It's been a wild ride so far, not only the past couple of weeks, but going into Friday here. We get this huge S&P rebalance as well that we're going to touch on a little bit here coming up. But initial thoughts, FOMC comes and goes. We finally get Powell at least acknowledging the fact that things are going to change going into next year.
Well, I mean, you got what the markets have been trying to price in ahead of time for quite some time, which is that some cuts are coming in next year, and there was some acknowledgement in the dot plot, and we'll get to a little bit of that. The market seemed to have got what it wanted, at least temporarily, with some strength. We'll talk about the breadth of some of the moves that you've had in the market, sort of extending past the Magnificent Seven. Clearly, there's some work to do in the energy space, but all things considered, if as a trader or a market participant, you didn't really have a smile on your face on Wednesday and Thursday as well going into today, then I really don't know. I don't know what you were hoping for. There's definitely some bears out there that are like, oh, come on, didn't you hear what he said when he hit the podium? And we'll talk a bit about how some of that got walked back. Mostly by some of the members that spoke after Wednesday.
Yeah, it was interesting even today. 3 separate Fed members come out talking all kinds of bearish once again.
Party poopers is what I call
and hawkish. And I mean, we had Frank on the show today, and I mentioned to him even, you know, this incessant need they seem to have to come and pour cold water on what happened back on Wednesday. But you mentioned the dot plot. We'll get to that in a sec. I want to show this to kind of start things off. A little bit of a different look when it comes to the CME Fed Funds tool. This is a comparison. So starting with the lighter colors going through to the darker colors a month ago versus where we are right now. So this is for the January 2024 meeting. So you can see where a month ago, the projections were suggesting obviously much stronger in the favor of a hold for January. Right now it's 87.6% in favor of a hold at that 5.25 through 5.5% rate. But here's where it gets a little bit interesting. If you go out to May, you can start to see why this is a little bit more important. Again, lighter colors a month ago through to where we are right now. By the end of the week here, we have come off a little bit, but that's 4.75, between 4.75 and 5% going out to May. Again, 5.25 right now, 4.75 going out to May. There's a little bit of distance there that we're going to have to travel, according to this at least.
Well, 100% right. Now, there's some participants, lots of people have been saying this cut's coming potentially even as early as March. But there's something to remember about the way rates work, and that is they tend to come down a little bit faster than they go up. So I don't think that look, if and when rates do move to the downside next year, you might not get these like little tiny quarter-point moves. The first one absolutely could be they just wait around and make a half-point move somewhere and start aggressively. Now, I'm not saying that's what it's going to be, but typically, historically, you should not be surprised. We should not be surprised if and when these cuts come through, that you can get something a little bit more aggressive initially. And the other thing to keep in mind with, generally speaking, why I will say that and why it's been true, is rates tend to come down for a reason. Have we had too many signs that the economy is in trouble? A lot of people would say no, but a lot can change in a single quarter. And if they have to, if the first cut is in reaction to a spike in unemployment, maybe they have to lower their projections, let's just say on GDP, and the first one's in reaction to that when they're already thinking about these cuts, well, then I think all the more reason that the first one could be a little bit aggressive. So there's still a lot that we don't know is going to happen, despite, I guess at this point, everyone expecting the cuts to come through. How it happens matters just as much.
Does it even matter? I think like we're getting to a point where it's like the market's going to do clearly what the market wants to do, and right now there's so much money on the sidelines, so much money waiting around to be put to work that
to be that money.
We're priced to suggest that this is coming. It's just a matter of when, and there's still so much more money sitting on the sideline waiting to get in.
I think, look, I obviously, I know there's lots of people, and you always hear this, there's all this money on the sideline, and you can see that when the dips have come in. Like anyone that takes a look at the chart of NVIDIA knows that it hits a certain level, and it's like, oh, the buyers just step up en masse. Like we've seen some big bounces in stocks like Meta. The Magnificent Seven have been amazing. Broadcom is going absolutely ham. Then you saw what happened with the Russell, the rotation into some of the small cap names.
Huge week.
I mean, how else are you going to? I mean, how else can you explain things like that if not money getting put to work? All that said, I still believe there is some room for surprise next year, and that can come in a couple of ways, right? Like that could come with a bit. The cuts could come faster, as I was sort of mentioning there. But I think the other concern would be faster cuts could come because of some kind of a shift in the economy. And if that happens, I think there's some names you got to be at least a little bit worried about that have been relatively strong. I mean, you look at some of the run and some of the retailers. I mean, I understand the concept of an Affirm. Well, maybe people will go to buy now, pay later if things get worse. But come on, if the consumer runs out of money and isn't spending at all, then that stock, which almost tripled, I think can come back.
Yeah.
So there are some things that I think can happen that could catch some people off guard that I think we should be prepared for going into next year. It's been a great run. That doesn't mean you have to get too, I guess the word would be too overconfident in this market.
Yeah, there's a lot of stocks, I think, that are a little bit over their ski tips, I think is the saying. I don't know. It's a great point. And I want to, just add to that in the sense that if obviously cuts are coming, but if it comes that quickly, that's actually not necessarily a good thing. Yes, it's a good thing, or would be a good thing for stocks and maybe individual names in the market overall, but it also would indicate that, there's some underlying weakness in the overall economy, as you mentioned, and the overall maybe a problem or an unforeseen problem in the overall economy. But if you go back to that last GDP print, we're still 5% on growth in the US. Canada's a little bit different, but Canada was negative for anyone in the US.
Don't say that.
2 in a row. 2 quarters in a row.
Everything's fine.
There's no R word here, though.
We're fine.
But it does lead us to believe that it's going to be a low kind of, or it should at least be a low kind of slow drawn out process.
Yeah, definitely. And you just mentioned Canada, things not as good there. But you also had in Europe, you heard some of the central banks commenting on maybe other banks were taking things a little too aggressively, talking about cuts. Who could they be talking about? Of course, they're talking about the Fed that matter the most. So yeah, I think there's some room for some caution in there. You got to be worried. And again, this comes from just observing the markets when we've been in rate lowering environments. It tends to be reactionary, and you're not lowering rates in reaction to good things. That's just not how things work. So if you're not at least paying attention to, okay, where's the most risk in my portfolio? Like, what are the things that I'm the most concerned about if there was a recession? And for everyone, it's going to be a little bit different. Some people might say it's the retailers. Like maybe I'm a little worried about my Caterpillar position. If things were to slow down, you have to have these things in the back of your mind. I still always believe in buy and hold, and I'm still pretty bullish on the overall market. But if I see signs of the weakening economy, understand that first big rate cut doesn't necessarily mean the market rallies off of that. That's not how things always work. It just doesn't work that way.
Definitely. All right, you mentioned this, and I want to get to this, and I think there's a good reason for it. This is the dot plot. It's a very exciting dot plot. If you're seeing this for the first time, I think it's a good opportunity to kind of explain, why for so long you probably haven't heard of this, and why for now, it's starting to become more and more of a part of the conversation, And a meaningful part of the conversation, you heard if you were listening to the press conference with Fed Chair Powell going back to last week, he referenced this, and part of that was because a lot of the reporters kept referencing this and pointing to this, saying, oh, but the dot plot, oh, but the dot plot, the dot plot, the dot plot, suggesting that we are going to be significantly lower, as we've been discussing here, by the end of next year. So the dot plot is projections. So each Fed member gets to put a dot on said dot plot that represents their opinion of where rates should be over time. So this goes out next year. This is 24, this is 25, and then this is 26. This column on the side, I know it's tough to see, but that's the interest rate. So obviously you can see there's a clear trend to the downside here, going out to anywhere beyond this black dotted line is longer term. So they don't actually put a number on it. They just say beyond 2026, what does everyone think? And the consensus here is 2.5%. That's still not 2% beyond 2026.
Yes. I think that's kind of the thing that maybe isn't being talked about enough.
Yeah.
And when you look at it, in some ways, as you mentioned, the dot plot has been a little bit more aggressive in terms of projecting against what some of the rhetoric has been, at least in terms of rates going to the coming back into the downside. But the fact that you're still that 2% target inflation rate that's out there, there is an acknowledgement on the dot plot that we could have some trouble getting all the way down there. And that is why you are seeing this almost floor at the 2.5 zone. So I think that's one of the things to interpret here. Some of the exuberance that you got, the rates are going to be lower, needs to be tempered on the longer end with the notion that when they have said rates could be higher for longer, that didn't necessarily mean 5% higher for longer. What it also might have meant is we're not going to see close to zero for a very long time.
Yeah.
Like that's the other thing. And the takeaway for me out of what we've seen in this market, and what I think seems like it's going to be true, is that notion of 0% interest rates and completely free money. As traders, as investors, just let's get that out of our heads.
Yeah.
Okay, because we're not seeing something like that. For something crazy could always happen. I'm sure there's always surprises out there, but there are a lot of reasons, and it's being telegraphed that we should just get that out of our heads and adjust to a new environment here, which might be that 2.5. So.
Yeah. I mean, let's be honest. It probably should have never been there in the first place. It depends on who you ask, obviously, but there's a lot of people with that opinion. And would it be the end of the world if, I don't know, 3.5 became the new normal? I think that's, where it was for a significant period of time, going back to the 80s and the 90s, and that's maybe where, things should be, coming back from 5.5, 6, maybe even 7%.
Well, you ask yourself this question. Well, we talk about this if it's a free market society, right? But then the one thing, which is probably the most important aspect of our economic foundation, which is sort of debt and borrowing and interest rates for that is something which is not decided by the free market. Yeah. So you have to, if it was decided by the free market, would we have had zero rates for as long as we did? Of course not. Yeah. I don't think there's anybody that with a straight face could actually say that. So yeah, I think it's probably healthy. I think it's right, and I think what this does, you have to have that cost to be able to determine like what's good and what's bad. This is the entire point of having to pay to borrow.
And no one obviously saw a pandemic coming. I guess.
Of course not.
But
what that, get the tinfoil hat on, we can do that. But
what that ended up causing is obviously very, very different. Wanted to show this real quick. It seems like a long time ago, but back on Tuesday this week, we got the latest inflation data as well. And I was actually surprised. I sat here and listened to the entire press conference on Wednesday afternoon with Powell. And it took them 35 minutes before somebody asked a question about this CPI print that came in, basically in line with expectations right across the board. But there were certain aspects of this report that were still quite concerning. And that chart you just saw there kind of highlights the fact. So the red bar here is just overall where we were, is 3.1% was exactly where where it was expected. 0.1% on the month-over-month increase was expected. Food still 3% higher. You jump over to this one, major category, so housing, rent, that type of thing, consumer goods, that type of things, 4% still higher. Really the only reason, Neil, that we didn't see a more significant uptick in the overall number is because energy came off, there you go, 5.5% to the downside. So thanks to, I think I actually dug into this a little bit more granular, and oil itself was 24% on a month-over-month basis. So we'll talk about oil here coming up a little bit, but you pull out those costs, or you pull out that negativity from this report, and inflation's still high.
Yeah, it's like sometimes I wonder if anybody cares about CPI at all anymore.
I don't think so.
That's the first thing.
The market doesn't.
The
that's
market
for damn sure.
certainly doesn't care, because as
the Dow's at all-time highs.
When you dig a little bit deeper, it's like, what celebration are we doing here over inflation, in a general sense? And there's been so many. I understand, like those that are like those that said inflation was going to peak back up, a lot of them were even pointing to energy as going to be a part of that story when you got a rebound in oil. Well, we'll probably talk oil a little bit individually there. That just hasn't been the case.
No.
But tell me, if you've been going to the grocery store, or anybody, look, we all have to eat, so we've all been buying food. I think we've all seen the lack of pullback in some of the prices there.
I feel like it's getting worse, honestly.
Yeah. Okay, but the job market's doing okay.
Yeah.
Companies, like I don't know, man. You run a business. If people can still afford to pay the higher prices on the way up, like prices need a bigger reason to come down. They're not coming down because companies feel bad about the fact that they're able to charge these prices. No, you have to have the demand come to the downside. This is why everyone keeps looking at the job market and waiting around. But remember one thing about the way that unemployment works. When you do get recessions and when you do have pullbacks in unemployment, and it's always like that lagging factor, it's like the last shoe to drop, it doesn't waste any time, right? Like when job cuts start coming and when layoffs start happening and the economy starts slowing, that's something that happens pretty quick, because businesses, they're gonna cut those, if bad things happen, they're gonna cut those costs. So I feel as if that's the missing part of the equation in terms of prices coming down more aggressively. But you've had to, I've been of that camp for a while, but I'll be the first person to tell you, hey man, it's a bull market. As a trader, just be wary of the fact that a trend is a trend until it isn't. It's your friend till the end when it bends. And regardless of what I think should happen, or we're ignoring CPI too much, who cares? The market can stay irrational longer than you can stay solvent. So yeah, I agree. The market's been ignoring CPI. We'll talk about oil as well a little bit later on, but I think there's definitely, as we said earlier, it's just showing you more and more signs that, hey, it might not be all roses. Does it mean sell everything right now? No, I think that's ridiculous.
Yeah, definitely. Let us know wherever you are watching, how things are there. Leave a comment down below, guys, if you haven't done so as well. If you're joining us for the first time, hi, welcome. We do this every single week. Hit subscribe too, guys. Join us back not only on the podcast every single week, Saturday mornings, 9:30, wherever you get your podcast. Join us Monday morning on the live show as well. Hit subscribe, hit like as well, and join us wherever you can find us. This chart kind of highlights exactly what we were just talking about, in the sense that this is core inflation. So take out housing, take out food, things like that. And you can see how choppy this has been going back to, over the past few years. Like there's no clear, as we were just saying, downtrend to note here still. And that's exactly what not only Powell is looking for, but obviously the Fed, before they get too excited here.
Yeah, I think and just maybe we can leave that up for a quick second there. I think the thing to note there is it flat out isn't a downtrend. Just because you have peaked doesn't mean you are headed all the way to the bottom. I think anybody that's seen a chart, right, like that's just not how things work out. You can have a nice trend, but last time I checked, trends require lower highs and lower lows, and we're not really seeing the aggressiveness in terms of getting some of those lower highs. Now, obviously, it is a win that we are nowhere near some of those heights that we saw in core inflation. Unquestionably, that is a big victory. But what's the best way to think about it is, when you run a race, Anyone that does any distance running, my wife did triathlons, and I used to run some cross country. That last kilometer, whether you're a marathon, you'd be running a 10K, whatever it might be, that last kilometer, it's not the same as the first, right? And I think that's exactly when you're running up a hill. Oh man, like the last 10%, when you're just getting to that peak, like your legs getting heavy, all that kind of stuff. It feels like that's what we're dealing with here.
Yeah.
Yes, you've made a huge percentage pullback overall in core, but it's that last little bit that is the most trouble.
It's true.
And again, this is why the dot plot's saying 2.5 for so long, especially past 2025, because they don't know.
No.
And it's that last little stretch, which could be some trouble. And if people are caught off guard thinking it's going to be easy to get back to 2, no, why would it be? It makes a heck of a lot of sense to me, and especially, and we talk, well, we can just talk some energy here. You're going to have a nice warm, well, okay, I'm not a weatherman or meteorologist, but everyone's expecting to have warm winters all around. What is that? Do you see nat gas is obviously tanking and demand? You got China worries for demand when it comes to oil. Okay, so if that's not going to be part of the equation.
Yeah. I just checked. It's 12 degrees outside.
Look, man, I'm wearing a sweater in here, but I got a short sleeve shirt underneath.
What day is today? It's December 15th, and it's 12 Celsius in Toronto.
My daughter was actually like teary-eyed asking me yesterday. I mean, she's been feeling sick, but she asked me, Daddy, is there going to be snow this winter?
Yeah.
And I said, Daddy can't control that.
No.
But it's not looking like it. Just because it's Christmas.
It seems like this is becoming a thing, right? Like last year it was a green, I think all of December was green. It was almost January before we got any sort of significant snowfall. So, I mean, you mentioned natural gas, and it's true.
Yuck that chart.
No one, I don't think, is using too much heat, at least, or they shouldn't be at this point, if you're living in this area. A couple things when it comes to crude oil. U.S. Energy Information Administration comes out and actually reduced their 2024 target price this week for Brent crude by $10. So they were at 93.94, all the way back to 83.84, and this all comes back to whether or not OPEC Plus is going to be able to come through with significant cuts that are going to lead to higher prices enough. And if you remember, just going back a couple of weeks ago, they delayed their latest meeting. I haven't seen at least a revised date for that.
But whenever the heck they want.
Exactly, but they're not even meeting, let alone talking about significant cuts that would help prices. So, yeah, we could see lower, definitely.
Oh, I mean, certainly. And then, look, I guess there was some positive economic data coming out of, industrial data coming out of China, which is, that's always going to be a big one, because as their economy goes, there goes some oil demand. But I haven't seen too many people that are bullish on them for the next year. So when that demand isn't necessarily going to be there out of China, you need something. If we don't get OPEC with those cuts, and on top of that, well, hey, when are they gonna start replenishing the reserve in the U.S. as well? So you have a lot of things which I guess people are waiting for strength in the Chinese economy, it's the demand to come back. You're waiting for OPEC Plus to make some stronger measures. You're waiting around for the U.S., which is producing a ton, by the way, to actually replenish their reserve. All of these things are not happening.
No.
You're seeing oil under pressure. I'm saying this is someone that just recently bought some Chevron that I'm like, oh, this looks fantastic. Everyone thinks oil's going up from here in the short term, and I expected us to have made at least some kind of a decent enough bounce going into the end of the year. Now I'm thinking about, okay, well, what happens in the first Q next year? And if this isn't going to be part of it, it's another problem for the strength of the overall economy. I mean, if demand isn't coming back, what is that signaling for the global economy?
Remains to be seen. I wanted to show this because we were on track there. I was just double checking. Again, if you're watching this on Saturday morning, we're recording this Friday evening. So I was double checking how oil ended the day. But this is a weekly chart of crude oil. So count them: 1, 2, 3, 4, 5, 6, 7, almost 8 weeks in a row. We do, it looks like anyways, get back to green to end this week, right back at, earlier support from this year. But that just kind of highlights exactly what we were talking about. Huge move down here, obviously, for oil.
Look, if on that weekly, if it gets to the support at 60 and the U.S. isn't buying, then that's funny business, period. You know, like that's just, it doesn't even make any sense because they were signaling buying under this support. I think it was in the mid 60s when it got down there. It's like, yeah, that's when you're going to replenish. And it makes all the sense in the world on that weekly. If you just simply pull it back up and look at where this was, it makes all the sense in the world underneath that 67 into 65. That's, you got to be buying down there. You're at 30-year lows for the reserve. I can't imagine you could get to those prices without A, the U.S. buying, B, serious action from OPEC plus. You know, barring some kind of a disaster as always. I mean, if something crazy happens and you know there's a catastrophe in the Chinese economy and demand absolutely plummets if we go into recession. No, those are all obvious caveats out there, but I can't see reasons why you don't get to those price levels and start to see some buy action. I think it's going to be a crowded trade of people saying the same thing I am, which sometimes scares the living crap out of me, because when something is ridiculously obvious, I always get afraid that, well, then why would it happen? But I mean, I don't know. Look at a chart of Uber going into it, add to the S&P 500, and the obvious thing happened and rallied like gangbusters going into that. So sometimes, you know, the expected is going to happen there. But I just can't imagine that we don't see a change on those three fronts if we get into the low 60s. It wouldn't make any sense to me.
All right, let's get on to more positive topics, shall we? Because there are a few. I want to touch on the NASDAQ here. This is the Qs, but you can take your pick as far as what you want to look at. For the NASDAQ, let's go all the way back to, this is the beginning of the year, 2023. And we are, as of the recording of this, it looks like wrapping out the week, 51% to the upside on 2023 for the NASDAQ. So what a year it's been. And oh yeah, DocuSign might be looking for some sort of deal as far as selling itself. What a year it's been for the NASDAQ. And the NASDAQ 100 specifically, I want to touch on a little bit here what happened on Friday as far as some adds and deletes from this index goes. But this is the NASDAQ 100 ranked by year-to-date performance. So if you, I don't know, have been on a very, very long vacation this year and have missed exactly what has happened in the market, it's been all about the NASDAQ and all about tech stocks specifically. So I mean, NVIDIA is insane, 225%, Meta 177%. This is CrowdStrike.
That's what I wanted to talk about.
130% for CrowdStrike, quietly at that.
This is that. Okay, that's the one. When we leave this up there, everybody's been talking about AI. Okay, everybody's been talking about the Mag 7. So there's no surprises to see the chip names that are going to be up there, and then the Mag 7 names, and then the Teslas and the Metas and the Nvidias. But it's not just it's not just CrowdStrike. You've got CrowdStrike on that list. I saw Zscaler in there. PanW is number 4 on that list. Cyber security matters. You've got geopolitical concerns out the wazoo. And in this AI, data is everything in the AI. Everyone's talking about the cloud. So if you're going to have these large language models essentially crunching everything, then you're going to have your data. Sometimes you're going to want to keep it in-house, but there are other times it's going to have to come out of the house and then going to be exposed. And there's breaches every single day. Now, some of this I probably hear way too much about it because my wife is she was actually a speaker in, it was like Women in Data. It was like,
nice.
Yeah, it's just locally here in Toronto. And so she's been, at conferences and she's been taking courses on it. And all you ever hear about, and she comes home telling me about all this place had a breach, and that place had a breach. And also, all it's made me want to do is buy more PanW, which I own. But CrowdStrike has been ridiculous. You cannot sleep on these. The valuation's been pretty high. But I feel like this has been lost in all of this rally, is how strong cybersecurity has been, because everyone's talking only one facet of AI, which is the chips. So it's all about the chips. There's more to it than that. It's more than just the chips and the cloud. And so when you see things that have been making these rallies, now I think some of it's it's getting a little stretched. But these have been absolute winners, no questions asked. And when we talk about the Qs in general, if there's a better argument for dollar cost averaging than what we've seen in this move, I cannot tell you how many people in the last back half of this year that I know sort of anecdotally that have come up to me saying, market's due for a pullback, right? I'm like, I don't know. Market's due for a pullback, right? I'm like, I don't know. I sort of buy the Qs every single month, and it's like, okay, keep on going.
Who cares if it is?
Who cares?
Yeah.
The trend has been absolutely unbelievable. Now,
Yeah.
all the things that we talked about at the beginning, I think show you some concerns there, but we've reached the top. And what happens if you break out tops on a weekly chart?
I mean, I think we need to be cautious with that term because we've reached a top.
I said a top.
Possibly not the top, but there's
A top.
There's some sort of a thing happening at something that resembles a top.
Yes, there's definitely a thing happening resembling a top. But look, the more important thing, going back to that graphic, because I think that's where we want to focus, is that there's been this impression that everything has been lifted by the Magnificent Seven. And when you look at the NASDAQ 100, there's a little bit more breadth, even if it is bunched in a couple of sectors, that we should be paying attention to there. And you can talk about a few names have already started to make some pullbacks. I'm looking at you, Adobe.
Yeah.
If there's one tech stock that the price action this week might scare you a little bit about the top, it's Adobe.
Yeah, I mean, you see Amazon, like things like Amazon, dead center in this as well. Airbnb, could have a long way to go as well. Here's an interesting angle with this, and I want to get your take on it. A lot of money from the investment side of things and from the institutional side of things has been sitting in money markets over the past year, 2 years, year and a half, whatever you want to call it, collecting these massive interest rate payments that we've been, giving out. Going into 2024, we're going to get rate cuts. It's a matter of when, not if, and it's a matter of how much, not, if at all. A lot of that money then, is going to be looking at equities saying, okay, can I get a better slice of a return over in the equity side of things versus money markets going forward? I read something that suggested right now there's $5 trillion tied up in money market funds, so bonds essentially. As much as $1 trillion of that could be put back to work in equity markets if a March cut comes through, if a May cut comes through to the tune of a 1/4 point. You were talking a little bit about Crowd and PanW and the cybersecurity side of things. That money is going to have to go somewhere. Are those the ones that we start talking about a little bit more going into next year after such monumental everything AI rally this year?
I'm kind of thinking maybe not. I find it hard that money that's been on the sideline in the money market is just going to be let's go jump into all the stuff.
NVIDIA,
and PanW, all the stuff that's already gone.
Yeah.
Now, to an extent, there's going to be buying in those names pretty much always. But I kind of look at something like healthcare. Well, financials participate. I mean, look at the good run the financials have had, and they're starting to make some bounces as well. If we get the rates holding maybe a little bit lower than expected, you can look at the IWM. But basically everything in healthcare that isn't, if you don't have a weight loss drug, you basically are, it's like everyone thinks you stink right now. And there's certainly some signs that you could be bottoming when Pfizer's at ridiculous levels. Merck got some good news, their valuation's like way down. And I look at the XLV there, and I feel as if like it's almost, it hasn't quite reached the tops and some big resistance levels. And it's like, okay, why wouldn't it press a little bit higher? And just if you're watching my chart, I'm sort of looking at a weekly chart of some of the healthcare names there, and I can see the reasons why money on the sideline should help to be able to press this, back up to some of those highs. Because breadth hasn't really been in the healthcare sector. I mean, anyone that's looked at the chart of Eli Lilly and it's just like where the winners have been, and you know where the losers have been. So breadth comes into that market. I think there's more room to run. I think there's still some space. You saw great runs in the financials recently. I think there's still some space for that to go. Of course, as I said, I'm going to say it a million times, especially when it comes to the financials. Look, if we get some kind of a shock in the economy going in Q1, I'm not going to feel as good about them as I would necessarily about healthcare. Look, I like the cybersecurity names. I think a lot of people don't realize how strong that they have been. That doesn't necessarily mean I'm rushing to be buying those at the top. I was patient and buying every dip that I could in something like a PanW, but I'm not going to be out there chasing highs You saw all the leaders on that board. It's difficult to buy them at tops in this environment. I think money's going to come. I think money's going to come in from the sidelines, but there are plenty of places it can go where there seems like there's more value.
Yeah, I want to touch on a few things here. I mean, we had a whole bunch of AI related stuff. I feel like the AI conversation has been very much overdone at this point. I mean, to sum it up, Intel comes out with a whole bunch of new products this week, few new chips on the AI side of things. AMD saying, $2 billion worth of potential sales going into 2024, specifically around some of their new products on the AI side of things. Broadcom reported huge earnings, huge week for AVGO. So chips specifically, I mean, as I said, the conversation seems like the same.
Yeah, oh, it's definitely more. What's interesting about this is it finally trickled down to Intel. Like everything that, I mean, the story has been, it's been NVIDIA, it then pivoted to AMD, Broadcom has had an incredible run. Intel's been coming off the bottoms for a lot of other reasons, like A was just under a lot of pressure, but how competitive they're going to be in the AI space doesn't matter. I mean, ultimately, you break down some of the numbers when Lisa Su was sort of talking about this, with regards to AMD and the size of the addressable market. Okay, so if AMD is doing $2 billion and NVIDIA is doing $29 billion, and NVIDIA's got 80% market share, but if that market in the next 4 years is growing 4x, and this is a $400 billion, I think that's the number that got thrown out there.
Yeah.
I mean, AMD can then, by that math, they don't have to gain market share to go 10x. So then the question becomes, okay, well, if Intel is jumping into the space, well, how much does Intel have to capture to be able to get a piece of that pie? And you're talking about a company which is now, what's the market cap of Intel as we speak? Like now it's like 195 billion, right? So if Intel even gets a sliver of that, a decent sliver of that, and they're able to get something else there. They've got the foundry play as well. So all of a sudden, people are starting to realize, hey, there's going to be some other winners out there. I mean, look at ARM. You have other kinds of technology as well in the AI space, right? So ARM, there's alternative technologies that ARM can be at the forefront of, and that's why that stock is going absolutely ham. So the word breadth gets used a lot. Well, we should be using the term breadth for the move in some of the chips in the AI space. It needed to be more than just NVIDIA. Yeah. NVIDIA, I still think NVIDIA is, there's just so far ahead of everybody else. It's like, this is like Tesla with EVs. I mean, like they're not relinquishing this anytime soon, but they are in a place where 80% can turn into 60% in 3 or 4 years, and it's not a big deal. Yeah. And AMD can only have a small piece, and Intel can only grab 5% of the market or whatever it might be, and that's still going to be a net win for them overall. So there's plenty of winners to be handed out here, but I can tell you, I mean, as an Intel shareholder, I'm pretty happy, but I looked at some of the rally, and it's like, really? So now they say AI, like, well, all the other things that are positive for them? Like, remember when Intel was going to have to spend a bunch on to expand their foundry competition play, and it's going to cost them billions.
And that's what they were going to be.
That's what they were going to do. Yeah. It's an expensive game, and rates are high.
And now they have AI chips.
Now they have AI chips. But hey, I'm happy. I'm happy for them. It's great that rates are going down. I think that's positive for Intel. I would almost argue it's as positive as the AI chips that they're going to have. Yeah. They got a ways to be able to prove they can catch up technologically. But again, a small piece of that pie, if the pie is growing 10x, what difference does it make?
Listen, as we said, it's not going to be just one. There'll be many, solutions to the AI chip problem. So let's jump down to Apple here, because something happened this week with Apple that was kind of interesting. We get back above this 3 trillion market cap number. I mean, that chart is a market cap chart of Apple going all the way back to 1985. So, I mean, if you've been long this at any point, I mean, we've pounded the table. We continue to pound the table on Apple. How can you not? Back above 3 trillion. A lot of the conversation this week, though, was more around who's going to be the next in the $1 trillion club versus, oh yeah, Apple's at 3 trillion once again and the biggest company on the market.
I've always thought it's more interesting who's going to be the first $5 trillion company.
Yeah.
Because this is actually a debate. It wasn't really it wasn't a debate at all, actually. I think it just one day kind of came up randomly where we're doing the regular trading show, And I don't remember the context of it, but we're sort of back and forth with Sean and myself, and I was sort of saying, well, is it a given that it's going to be Apple at the $5 trillion mark? Like, why can't it? Like, why couldn't it be? Why couldn't it be Nvidia? Why couldn't it be Tesla? And I'd almost, like, you got to give odds on this kind of a thing because obviously Apple's already at $3 trillion. The other names are so far behind. But I don't see why it's an absolute given. Like, Apple seems like it's at a maturity level. At least to me, and what I've sort of been looking at in terms of like, okay, well, what's new for them at this point? It's become more important, the recurring revenue and the services, which I think is still fantastic. They've got the great ecosystem. They've got you lined up in a lockstep. But there's a lot of people that tend to think that, hey, they're a little bit behind in terms of integrating AI into devices. I mean, Meta and Alphabet have done so well there.
Where's the growth going to come from?
Where's the explosive growth going to come from? I don't have any concern about Apple in my portfolio, but I don't think it's a given they're the first $5 trillion company at all. And you talk about like what could be the next $1 trillion company. There's so many names out there. I think okay, well, could it be a weight loss company? Could it be one of those drugs? Could it be something?
That's a volatile trade.
Okay, no. I'm just playing devil's advocate for you. I think more people would be inclined to believe that automated driving is something that could take us into that.
That's where I would.
I'm not saying that because I only Lilly. Again, it has nothing to do with that. I just playing a little bit devil's advocate as to how big that market could potentially be if things break the right way. It could be just as ugly if things break the wrong way. But I think the obvious answer is automated driving. I think that's the catalyst that gets the next $1 trillion company. Now, there's obviously play there. You have Tesla as well, but I mean, you just had Uber go into the S&P 500. I think it's pretty obvious that they stand to be a big winner when automated driving comes. There's just no question. There's just no question about it.
It's an interesting idea, and there's two sides of this that come to mind. A is Elon's relationship currently with the U.S. government is, anything but positive, I would say. And then the other side of it is the amount of data that Tesla is able to accumulate from their cars on the roads all over the world, remember, is going to easily surpass anything that anyone else can do for decades, I would even, go to say. Because they are collecting this data in real time right now as you and I are sitting here, talking about this. And, GM can't even figure out how to do it.
Don't get me started on it.
In a little tiny square in San Francisco. So when it comes to automating, it's going to be Tesla. It's a matter of, how they solve this autonomous problem and when it gets solved and then how they are able to, capitalize on that. Can Uber play? I don't know.
I don't know, but for anyone that's only listening to this, the second you said can GM, I immediately was like rubbing my temples because it's an absolute. It's been a mess for them.
Yeah.
But my favorite analogy for that, to the data being so far ahead in data. I always make the comparison between Google and Apple Maps, right? Like, why are Google Maps better? Everyone understands because data collection and privacy and all that kind of good stuff, and that's why it's better. Tesla is so far ahead. You're talking about a man and a company and an infrastructure which was like remotely landing rockets.
Exactly.
Which is going to send us to Mars.
Yeah.
Which made have you seen the damn Optimus thing? It can pick up
version 2.
It can pick up an egg.
Yeah.
There's nothing scary about that, first of all. Yeah, no. I want a life-size robot with an AI in it that's so delicate that it can already pick up an egg, and by next year it's going to be able to thread a needle. Okay, well, I mean, what do you think comes after that? Anyway, so
what could possibly go wrong?
Everything is absolutely fine. But the greater point there is, so with that advancement in data, with the head start in data, and a company which is and the leadership which has proven that they can do all these things that nobody thought was possible, light years ahead.
Yeah.
They're going to be the ones.
Yeah.
When it comes, and for me, this is where Tesla bulls are at. It's because they believe that this is going to be.
Of course.
And what is
that worth? Yeah, of course.
When it happens, what is that worth?
Yeah.
that the world and all of the major cities go to 80-90% automated driving. It's going to happen.
Yeah.
It's a matter of when it happens.
Yeah.
And if at the forefront of it is Tesla, the same way you're seeing with charging stations where Tesla's becoming the norm for the Tesla charger, well then what happens when it's their self-driving technology powering everything? Okay, because I think, and look, I'm not going to sit here and tell you that I'm a coder, but anything I've read on it says, you know, if you've got one intelligence and one sort of thing backing the vast majority of vehicles on the road, the safer it becomes because they're all running on the same logic, and it becomes a lot safer that way. So there's a sense that it's going to be Tesla.
Yeah.
So anytime someone asks me what the $5 trillion company,
that's the easy. Yeah.
Like who's gonna rule the world in 50 years?
Yeah. No, it's a good point. And going back to what I was saying, you know, to start this off, I think maybe the only hiccup and the only hurdle that they run into on that path is the government and the relationship that those two sides have at this point.
He's too honest. I think that he doesn't play the game. I don't know. It's not to criticize.
Let's not even go down that road because that'll be a whole nother conversation.
That's a whole other conversation.
Listen, we went from Fetcher Powell right through to Elon. It seems like a commonality around here as far as what is covered. I have a favor to ask anyone who is watching, if you're watching for the first time as well. The way that we improve this, the way that we add value to you and your viewing experiences by you subscribing, it would help us out so much to just hit the subscribe button. Come join us on Monday for the live show, TraderTV.Live, or you can go to YouTube.com, TraderTV.Live as well. Leave a comment down below as well. Let us know what you want us to discuss. We have a tradition to end things off around here. As far as podcast goes, every single week we talk about one thing that we like, one thing that has lifted our lives in the past little while. Doesn't matter what it is, doesn't matter where it comes from. Tell me your one thing.
So this is, I was just in Halifax visiting my brother.
Yeah.
My brother is a bit of an artist. And so the number one thing that and this is not really a thing in the traditional sense, like when I talked about the weighted blanket last time I was on, but my brother's condo was probably the most Christmas I have ever seen. It was absolutely amazing, and he's got my two nephews are pretty young. I've got a young daughter, and it was just the amount of homemade like ornaments. He had 100 of those like snowflakes, paper snowflakes that you make. It's the simplest thing out there, and he's hanging them. And so the one thing that sort of changed recently for me was I immediately came back from that trip, and I told my daughter about it. And she's like, let's just make some simple crafts. And so, you know, she made this little heart thing. I love you, mommy. I love you, daddy. That's gonna go on a tree, and we're gonna be hanging stuff. And it's more about just doing things with your hands and making homemade crafts. The other thing that we started doing, we built this. It's a little tiny wood tractor for her. Little tiny wood pieces that you put together, just intricate. And there's something about doing that which is so incredibly satisfying.
This time of year.
As opposed to like I can buy a piece of art and I can buy a model. But especially this time of year, you get quality time out of it. You get something beautiful that you can display. So again, whether you're the type of person that makes gifts for people or not, or that likes arts and crafts or not, I'm just telling you, like I'm not into it. My brother's the artist. I'm not. I kind of suck at that kind of stuff. But there was something incredibly fun about making some homemade ornaments and doing some arts and crafts with my daughter. So that's the big thing for me. But what about you?
No, I love that. And like we said, this time of year it's special as well. We actually went from a fake tree to a real tree 2 years ago. Not last year, but 2 years ago. And it was simply because our fake tree was getting to a point where bad things were happening, and we didn't really want to stand around breathing whatever was coming off it. Anyway, no, it was plastic, obviously, because that's what fake trees are. But it was almost like disintegrating, and it had this like crazy chemical smell coming out of it. And
you want to tell us what the brand of that tree is, so none of us.
I have no idea.
Anyway, then. I still have a fake tree. We used to do real, but then like my mother would come over and she would have issues sometimes.
No, it's
whatnot. So
it totally changes the experience. But
I prefer real.
Yeah.
That doesn't sound too good, Brendan.
No. It's long gone. It's garbage now. But anyways, I had a great food experience going back to a week ago on the weekend, and I wanted to shout out this restaurant here in Toronto. If you're in Toronto, Alder restaurant, fantastic. This was actually, it wasn't a Michelin star, but they did get a Michelin mention in this year's Michelin guide for Toronto. So this is the chef. There's a very, very famous restaurant in Toronto called Aloe.
Yes.
So this is his second iteration of a restaurant. It's in the bottom of a hotel on Camden Street. Go check them out. Shout out to Alder. They did not sponsor this podcast, but I'll give them a shout out anyway. So.
Well, you just made me want to go there.
Yeah, no, it's fantastic. Fantastic.
Aloe is. I've been there a couple times. I think it's absolutely fantastic. If you get a chance, eating at the bar is fantastic at Aloe. But yeah, I will be checking them out in the new year for sure, Brendo.
Interesting week coming up, and I think we can wrap it up on that. It's going into the holiday, obviously. The week before Christmas is always, let's be honest, kind of slow. There's not a lot going on. Anything you're looking forward to as far as the market's concerned this week?
Well, I think so. Sean and I talked about this, like a stock that's maybe the extended rallies, like in a firm. There's going to be names that have had extended moves that you can expect volatility in. Now, does that mean a firm's going to pull back and give us the short that we're looking for? I don't know, but I'm expecting a few names that have really gone parabolic could have some volatility. Like, you've got to get really specific as you go into the end of the year, right? You want to be trading the right names, so you don't want to get chopped up. So, the best thing you can do is be really discretionary and really patient, and I think you'll be just fine. And of course, tune into us every single morning at 8:30 to get the stocks to move. Exactly.
I think Uber is going to come back to earth a lot in the next few days here. If you're participating in the market for the first time going into the end of the year, there's a lot of positioning that happens.
Yes.
There's a lot of money moving that happens before January 1st. Uber has had a monster move into this S&P inclusion. And typically what happens after big inclusions into an index is you get some profit taking. So
Lyft too.
Yeah, Lyft had a huge run up into this weekend as well. So let's watch out for both of those going into next week. So there you go. Episode 5 in the books. Boom. Great stuff. Neil, have a great weekend.
You as well, everybody.
Everybody, we'll see you on Monday. That was fun.